down 66% in 2022. Is Spotify stock a buy for 2023? I'm going to answer that question using several different metrics in this video, so please stay tuned to the end to find out. The first thing I'm going to look at is Spotify's revenue growth going back to before 2019. And what you can see is a downward trend with an upward trend in the middle of the overall longer term downward trajectory. Revenue growth was over 36% in the early parts of 2018, 2019, and that has fallen in its most recent quarter to just 3.72%. The longer term trend does not look good for this streaming content company trying to attract users and grow its top line by contracting popular hosts like Joe Rogan and the like, but it's just having difficulty generating or accelerating that revenue growth again. The next thing I want to look at is Spotify's operating income, and similar to its revenue growth, you could see a downward trend here. If we start from right here in before 2019 and 2018, and we just draw a line through the latest results of negative 229 million, we see a downward trend, and worse than that, more importantly, we see negative operating income in several quarters. So the company is not consistently profitable either. So decelerating revenue growth, decelerating operating profitability. So far, this does not look good for investors. The next thing I want to look at is Spotify's cash flow from operations, because many times, and if you've been following my channel, you've noticed that some companies have negative operating profitability, but they have positive cash flow from operations. And you might ask, how is that possible? How can a company not be profitable, but then at the same time be generating positive cash flow from operations? And the difference comes primarily as a result of stock-based compensation, where these technology companies are able to pay their employees in stock-based compensation, in stock grants, in stock options, and that allows them to generate more cash flow because they're not paying their employees cash. But at the same time, they still need to account for that stock-based compensation on the income statement, so that shows up as negative profitability. So that's the case for Spotify here. It's positive cash flow from operations consistently, even though it was losing money on the bottom line. And finally, let's look at Spotify's valuation to determine if the stock is a buy. And we looked at its price to free cash flow because, as I mentioned earlier, it's generating positive cash flow, but at the same time it's negative profitability. It's not consistently profitable, and so the price to free cash flow gives us more data going back over several years without spotty gaps in terms of profitability. So I chose to use the price to free cash flow. And looking at this metric, it's trading at a price to free cash flow of 81.83, which is expensive on its own right. But if you look at it historically, this is about the cheapest you've been able to buy Spotify for in terms of this metric. But that doesn't mean it's a good value, right? If something was super expensive and now it's just not as expensive as it used to be, but it's still really expensive, you don't look at that as a bargain. You just look at that as the price has come down. It's the cheapest it's ever been, but that doesn't make it a bargain. A price to free cash flow of 81.8 is not a bargain, especially when you have these types of cash flow from operations metrics where you're not seeing growth in that metric. You're not seeing very much growth in terms of profitability or revenue. And so I would not want to pay a premium valuation like this for a company with these kinds of metrics. So I guess that answers my question. Is Spotify stock a buy for 2023? I'm going to say no, it's not a buy. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.